Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the S&P 500. I'll come back and talk about the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all that said, let's get into our first chart. Now, I've got the S&P 500 on the screen, and gravity has finally caught up with the S&P 500, and prices have pulled back to the 50-day moving average. So I've got the 50-day and the 100-day moving averages on this chart. And on Wednesday, the S&P 500 has had its first 2% down day since December 2022. Now, I'll tell you why that is significant in a moment. It's actually really interesting, so just hold on a moment for that. But first, I want to look at what's been driving this sell-off in the S&P 500. And of course, it's been led by big tech, stocks like Nvidia, Microsoft, Alphabet, which is of course the company for Google. And we specifically spoke about Nvidia a few weeks ago. And just jumping over, having a look at the price action for Nvidia. Now, you might remember one of the things we did a few weeks back, we put on this indicator. This is a really useful indicator. It shows the percentage a stock moves away from its 50-day moving average. And what you find when you look at the history of Nvidia, just compress this price a bit. This is where it was a few weeks ago. We got to around 40% above its 50-day moving average. And you look at the history and you can see that once it gets to that sort of elevated level, gravity typically kicks in and you get that snap back decline. And that's very what we've seen over the last few weeks. The snapback in price has certainly won, and Nvidia has come back to its 50-day moving average and is now close to the 100-day moving average. Same sort of price action you see playing out in those other big tech names. And over the last week, we've been discussing the last few weeks, we've been discussing the strategy of not buying the index, i.e. the S&P 500, but instead focusing on the components. And the reasoning around that has been not wanting to chase these stocks which had run really hard. I've got no problem with holding a stock which has run hard, but I don't want to buy a stock after it's run hard because this is a risk you face. You get that snap back to the averages, and then instead focusing on those stocks which have been breaking higher, stocks which have been rallying out of ranges, rallying off their moving averages. That's where I think the opportunities have been. Now, let's quickly duck back to the S&P 500. Now, I want you to take a mental snapshot just of this last few months of price action. Now, remember that for a sec. Now let's jump over to the equal weight, the S&P 500 equal weight. This is an ETF. And you'll see the price action is quite different, particularly over the last month. And the equal weight, of course, has been holding up better. It too is pulling back. It's pulled back over the last couple of weeks as well. But the big difference being is that it's holding on to most of its gains from July. Now, contrast this with the S&P 500. Come back to the S&P 500. Look where it traded, where it closed on Thursday. Come across, and it's the same level it was at back in, say, around 12 or 11 of June. Back over to the equal weight, it's only come back to where it was on around the 12th of July. So it's really held up quite a bit better than the S&P 500. And as we've been discussing, the sell-off in big tech is having a whole lot less impact when you look at the components that put the S&P 500 together. You take out that market cap weighting, which is driving the index so much at the moment. And we've also, the other thing we've been discussing is this breakout We've got a 3-month period of consolidation, consolidating along the moving averages, a compressed trading range. We had the breakout. Now we're getting the pullback. And the way a breakout often works, is you get the initial surge and you do then get the pullback. So from that perspective, what we're seeing is pretty typical type of price action. We've also got this 50-day moving average coming up beneath current levels. So I think this is a really important area for the equal weight. If it was like, if this breakout we had a couple of weeks back, if that's going to hold, then this is really where the buying needs to come in, underpin the price, and start to develop a new base at these lows from the last couple of days. I think if the equal weight were to make its way back beneath the 50-day moving average, back within the body of the range, well, I think then would need to be saying, well, look, we've got a false break. We're dealing with a false break, and that would swing the odds in favour of a longer consolidation. I don't think we'd be looking at saying, look, this has turned the situation bearish, but I think it would be saying there's a longer consolidation. So I think this is a key area to watch over the next week. At this point, overall trend is up. S&P 500 has pulled back to its 50-day moving average, which is a normal thing in a bullish market. Bullish markets pull back to these moving averages on average every few months. It does happen. It's not unusual. It's normal within a bullish market. So we've also got, don't forget, we've also got that broadening participation, which we can see through the equal weight ETF. So I think that's overall positive. So I'm remaining long stocks. I'm using those wide trailing stops to manage risk, but also try and see off these pullbacks, which we're invariably going to get. And I think that's an important way to approach any bullish phase. Wide trailing stops, try and stay with the trend until you have clear evidence that you should be getting off or taking risk out of the market. Now, I want to tell you about the significance of the 2% down day in the S&P 500. Also, we're going to have a quick look at the small caps, at the Russell 2000. First of all, though, if you're getting value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. You're just telling YouTube that you're watching, you're engaging, then YouTube goes and shows other people. That helps me. It helps my channel a lot. Please do those things. Hit that subscribe button if you haven't already done so. Now, let's get back to this 2% down day. Now, this was really interesting. This is an article and headline I saw through the week. The S&P 500 snaps longest streak without a 2% decline since 2007. In the first sentence of the article, it goes on to say, ending its best streak without a 2% decline since the start of the global financial crisis in 2007. So the article, we're talking about streaks since 2007. We're bringing the GFC into it. I don't know. I think for a lot of people, does that plant a seed of this is something we should be concerned about? So let's put this into some perspective and go and do some investigation. So coming over the S&P 500, I've got this on a weekly chart so we can see the periods in question. I just firstly, just scrolling down to the lower end of the article, it's got this interesting graph. So this just shows the length of time. So I've got this almost a year from 23 through 24. That's the period without a 2% decline. Then we've got this other period from around mid 2016 through to about 2018, another year or so without a 2% decline. And then we've got this long stretch leading into the GFC without a 2% decline. So it seems that when we get these declines, bad things happen. So let's go and have a look. Here's this first one. Here's this period from 2016 to 2018. Nice strong period. Market got stretched above the moving averages and then pull back to the 50-day moving average. Oh, actually, this is weekly. It's a weekly chart. So pull back to the 50-week moving average, stabilize, and then continued to rally for what's that? Maybe another 9 months to a year or so before something larger, but probably unrelated to that 2% decline. Going over and looking at the GFC period, long period without a 2% daily decline. GFC started 9 months later. Is it related to a 2% decline in a day? Probably not. It's probably coincidental that it's occurred around that 2% decline. It's interesting when you look at the data. So this is like two events which led to volatility after a 2% daily decline. But when you go back and you look at the data going back to, say, 1950, most of the times that these streaks have ended, where you've gone a long time without a 2% daily decline, most of the time the market has been higher 6 to 12 months later. So just be careful. Just be careful with looking at headlines and looking at headlines and using a small sample size of data. I don't know, but for me, I don't think they're helpful. They can give false impressions of how things actually play out when you look at more sample over longer time frames. Now, just quickly, let's just wrap up with the Russell 2000. This has been a constructive week for the Russell. Big rally mid-July. We've been tracking sideways since, getting that weakness in the S&P 500. It's not showing up in the small caps at this point. As I said last week, sustainable advances you're typically at a rally, you get a sideways consolidation, and then you'll get another rally. Healthy price action could include several more weeks of sideways price action, even slightly lower. Just let these moving averages catch up. I think if you missed the initial break higher, I think the play for the small caps would probably be, my preference would be to let this consolidation play out a little bit longer. There is volatility in the markets. No need to buy into a consolidation. Let it just play out a bit longer, and also look for the individual stocks. I think that's where a lot of the opportunities have been in recent times. So look, let's call that a wrap for this week. Thank you for joining me. Hopefully that's been interesting. I look forward to coming back, talking to you again next week. Until then, bye for now.